It's March 2026. Inventors have worked hard, saved their capital, and are ready to put money to work in the one sector that has historically minted more millionaires than almost any other: real estate. But as investors look at the market today, something feels different. The headlines are screaming about a REIT renaissance, yet interest rates are still refusing to play nice. Investors see one REIT offering a 7% yield that looks like a dream, and another offering a boring 4% that looks like a pass. But here is the problem. In a world of shifting inflation and AI-driven logistics, the 7% yield might be a value trap designed to catch unsuspecting investors, while that boring 4% company might be quietly doubling its property value behind the scenes. Most people approach this March madness by chasing the biggest number on the screen. But today, we're going to do something different. We're going to look at the invisible metrics, things like AFFO payout ratios and the strategic pivot into data centers. We're putting four of the biggest names in the game, VICI, Agree Realty, Realty Income, and Prologis, under the microscope. We aren't just asking if they pay a dividend, we're asking if they have the structural power to survive the next decade of economic shifts. I will reveal which door leads to real wealth. Let's get started. Before we start, remember, this content is for entertainment purposes only and does not constitute financial advice. Before we start, please make sure to like and subscribe so you don't miss any future videos. VICI Properties, the experiential fortress. Let's start with VICI Properties. Now, VICI is a fascinating case study in tenant psychology. While most REIT have to worry about tenants moving out or downsizing, VICI owns the land under assets that people cannot walk away from, the Las Vegas Strip. In late February 2026, VICI just dropped their full year 2025 numbers, and the data is telling a very specific story. They reported a 5.6% jump in AFFO per share. That might sound modest, but here's the kicker. They just committed over $2 billion in new capital at a weighted average initial yield of 8.9%. In a world where the cost of debt is hovering around 5%, that spread, the profit they make on the difference, is massive. But there is a shadow over VICI this March. They have two major debt maturities coming up later this year, $500 million in September and over $1 billion in December. Management is signaling they'll hit the bond market soon to refinance. If they get a favorable rate, the stock could fly. If they don't, that 6.4% dividend yield is going to have to do a lot of heavy lifting to keep investors interested. It's a high-conviction play on the experience economy, but investors have to be comfortable with their massive concentration in just a few key tenants. Let's do a backtest and look at the numbers. I will assume a weekly contribution of $100 with all dividends reinvested, DRIP. These estimated calculations are not exact, but are based on historical price data and dividend distributions as best as possible. After 5 years, the total amount invested equals $26,000. However, during this 5-year timeline, capital appreciation is $7,000, and reinvested dividends adds about an additional $5,000. The total portfolio value after these 5 years equals roughly $33,000. At this point, yearly dividend income is about $1,950, which calculates to $163 in monthly dividend income. This is not enough to retire off of, but it is enough to pay a cell phone bill or a very nice dinner for two each month. Now let's look at an 8-year backtest, since that is the farthest back we can go with VICI, since it was started in 2018. After 8 years, the total amount invested equals $42,000. During this 8-year timeline, capital appreciation grows to $15,000, and reinvested dividends adds an additional $9,200. The total portfolio value after these 8 years equals roughly $66,200. At this point, yearly dividend income is at $3,500, which calculates to $300 in monthly dividend income. This is not enough to retire on, but it is enough to pay a cell phone bill or a very nice dinner for two each month. Prologis, the AI Trojan horse. Next, we have the heavyweight champion of industrial real estate, Prologis. If you've ever watched a video on the macro economy, you know that logistics is the backbone of everything. Prologis is currently sitting on a hidden gold mine that they call lease mark-to-market. Basically, they have old leases from 4 to 5 years ago that are finally expiring. When those tenants renew this month, Prologis is raising the rent by roughly 45% to meet current market replacement costs. That is an insane amount of built-in growth that doesn't require them to buy a single new building. But here is the real 2026 story: data centers. Prologis isn't just storing boxes anymore. They are positioning themselves to store the internet. They are planning $30 to $50 billion in data center development over the next decade. Management just boosted the dividend by 6% to $1.07 per quarter. They are the only REIT in this group that feels like a tech company in a real estate wrapper. If the AI boom continues through 2026, Prologis isn't just part of the bracket, They might be the ones owning the stadium. Let's do a backtest and look at the numbers. I will assume the same weekly contribution of $100 with all dividends reinvested. After 10 years, the total amount invested equals $52,000. During this 10-year timeline, capital appreciation rises to $45,500, and reinvested dividends adds about an additional $6,600. The total portfolio value after 10 years equals roughly $104,000. At this point, yearly dividend income is about $2,900, which calculates to $240 in monthly dividend income. I'm going to look back to see how Prologis has performed over the last 20 years. After 20 years, the total amount invested equals $104,000. During this 20-year timeline, capital appreciation grows to $123,000, and reinvested dividends adds an additional $28,000, making the total portfolio value worth $255,000. At this point, yearly dividend income is at $6,700, which calculates to about $560 in monthly dividend income. And finally, the 30-year backtest. After 30 years, the total amount invested equals $156,000. During this 30-year timeline, capital appreciation grows to $223,000, and reinvested dividends adds an additional $58,000. The total portfolio value after the last 30 years equals roughly $437,000. At this point, yearly dividend income is at $11,000, which calculates to $925 in monthly dividend income. It's important to remember that these are real historical numbers, not some future returns that may or may not happen. This is what the REIT actually returned and paid in dividends. In a moment, I'll show a REIT that appreciated to over $600,000 with only $156,000 invested and is paying over $18,000 a year in dividends. So stay tuned. Realty Income, the anchor under pressure. Then we have the monthly dividend company itself, Realty Income. For 33 years, they haven't missed a dividend increase. But as we look at the bracket for March 2026, the king is facing a scale problem. Realty Income has become so huge, with over 15,500 properties, that they can't just buy a few convenience stores to grow. They have to buy entire companies. This is why you're seeing them move into Europe, the UK, and even Mexico. They just guided for 2.8% AFFO growth in 2026. Now compare that to the 5% to 6% growth we're seeing from the smaller players. The madness here is that investors are starting to wonder if O has become too big to succeed at a high level. They just affirmed their 668th consecutive monthly dividend, but with their rent recapture rate sitting around 104%, they are effectively just keeping up with inflation. It's the ultimate portfolio anchor, but don't expect it to provide the same fire it did 10 years ago. It's a stock people buy for the check, not for the chart. Let's do a backtest and look at the numbers. I will assume the same weekly contribution of $100 with all dividends reinvested. DRIP. Again, these estimated calculations are not exact, but are based on historical price data and dividend distributions as best as possible. After 10 years, the total amount invested equals $52,000. During this 10-year timeline, capital appreciation rises to $20,800, and reinvested dividends add about an additional $11,700. The total portfolio value after 10 years equals roughly $84,500. At this point, yearly dividend income is about $3,600, which calculates to $300 in monthly dividend income. Now let's look at a 20-year backtest. After 20 years, the total amount invested equals $104,000. During this 20-year timeline, capital appreciation grows to $88,000, and reinvested dividends adds an additional $83,000. The total portfolio value after these 20 years equals roughly $275,000. At this point, yearly dividend income is at $9,330, which calculates to $780 in monthly dividend income. And finally, the 30-year backtest. After 30 years, the total amount invested equals $156,000. During this 30-year timeline, capital appreciation grows to $214,000, and reinvested dividends adds an additional $227,000. The total portfolio value after these 30 years is almost $600,000. At this point, yearly dividend income is at $18,000, which calculates to $1,500 in monthly dividend income. Agree Realty, ADC, the safety expert. Next up is Agree Realty, or ADC. If VICI is the high-stakes gambler, Agree is the disciplined expert. They specialize in net lease retail, but they don't buy just any retail. They buy the stuff people use every single week. What makes ADC a March Madness contender is their balance sheet. In a volatile market, the company with the least debt usually wins. Agree just secured an A- credit rating and is performing great year to date. To put that in perspective, while their competitors are struggling to fund new deals, Agree is actually raising their 2026 investment guidance to $1.6 billion. They just declared their monthly dividend for March at 0.262 per share. It's a 3.6% increase over last year, which reflects their slow and steady philosophy. They aren't trying to hit home runs, they are trying to hit singles every single month. For the investor who wants to replace their paycheck without the heart attack volatility of the broader market, ADC is often the first place they look. But the question is, at its current valuation, are people paying too much for that safety? Let's do a backtest and look at the numbers. I will assume the same weekly contribution of $100 with all dividends reinvested, DRIP. These estimated calculations are not exact, but are based on historical price data and dividend distributions as best as possible. After 10 years, the total amount invested equals $52,000. However, during this 10-year timeline, capital appreciation rises to about $44,000, and reinvested dividends adds about an additional $17,200. The total portfolio value after 10 years equals roughly $113,000. At this point, yearly dividend income is about $4,000, which calculates to $330 in monthly dividend income. Now let's look at a 20-year backtest. After 20 years, the total amount invested equals $104,000. During this 20-year timeline, capital appreciation grows to $146,800, and reinvested dividends adds an additional $71,500. The total portfolio value after these 20 years equals roughly $322,300. At this point, yearly dividend income is at $10,400, which calculates to $870 in monthly dividend income. And finally, the 30-year backtest. After 30 years, the total amount invested equals $156,000. During this 30-year timeline, capital appreciation grows to $296,000, and reinvested dividends adds an additional $206,000. Think about this for a second. A DC paid someone who started investing 30 years ago $50,000 more in dividends than the person invested. No wonder REIT makes millionaires. Remember, these are real numbers, not what could be. The total portfolio value after these 30 years equals roughly $660,000. At this point, yearly dividend income is at $18,700, which calculates to $1,560 in monthly dividend income. At this point, someone who started investing in ADC 30 years ago will get back their invested capital about every 8 years. The final verdict. So, who wins the REIT March Madness for 2026? The data suggests that the REIT sector in 2026 is no longer a monolith where every stock moves in tandem. Instead, the winners are defined by how they leverage their specific niche. For the growth strategy. If the goal is the highest potential for capital appreciation and a strategic stake in the AI infrastructure shift, Prologis is in a league of its own. Its ability to pivot into data centers makes it look more like a tech utility than a traditional landlord. For the safety strategy. If the priority is a fortress balance sheet with sub-4x leverage that is designed to survive a deep recession, Agree Realty is the primary defensive play. For the income strategy. If the requirement is simply a reliable, boring monthly check to act as a portfolio anchor, Realty Income remains the undisputed gold standard. For the opportunity strategy. However, if the focus is on a high-yield monopoly over the experience economy, VICI Properties is the wildcard. With a dominant hold on the Las Vegas Strip and a pivot into high-yield financing deals, it offers a level of inflation protection through its CPI-linked leases that the other three lack. The key to navigating this March Madness is recognizing that these four assets are not interchangeable. One provides the growth, one provides the shield, one provides the anchor, and VICI provides the yield. Matching the stock to the specific structural need of the portfolio is the only way to win the long-term game. Which one of these REIT do you think will be the 2026 March Madness REIT champion? Or do you think another one will make it? Comment below. If you made it this far, please make sure to like and subscribe, as it really helps support the channel. Do you want to know what ETFs are facing their own March Madness? Click on the video to see that video. Thank you for watching, and I'll see you on the next one.